It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, as always, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
Well, Mike, another tax season is in the books. But before you forget about taxes, what changes do you need to make right now to make next year's taxes and tax season even better than this year? Those tax planning tips and more coming up on this episode of the Wise Money Show.
I can't imagine a geekier topic, but we are going to get into it, and we're gonna help you. Because, tax preparation is an event. Tax planning is a process that's ongoing and tons of value. And so we're going to help you with that right now. If you have questions for the program or need some help, we'd love to help you. You can contact us, call or text 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com. And then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. Okay, April 18th. We all know that it's tax day, right? It's got a good ring to it. Just kidding. The 15th was on a Saturday, and then it should be the next Monday, but that was Emancipation Day in Washington, D.C. So April 18th, it's behind us. But listen, give a CPA a hug. Just appreciate a CPA if you actually.
You should ask them first.
Yeah,
though.
okay, because they're not really the touchy-feely. Just thank a CPA.
For the most part, they don't like people.
Listen, so this is now 4 straight tax seasons where the IRS has made changes during tax season.
It's terrible.
It is, and on top of just the chaoticness and the national shortage of CPAs as well, they're all busy, and just thank them, show them some love. You might not want to, though, depending on how your taxes turned out, right? So how did they turn out? Most of us kind of grade how tax season went on whether we got a refund or whether we owed, and we would blow that up. That's the wrong measure, okay? Instead, we would encourage you to measure a successful tax season on, well, did you have any surprises or did it turn out the way you expected? And then did you capture all of the right opportunities, right? That's tax planning. We're going to help you with that right now. Josh, what else would you say about the tax planning process?
Well, I often think of tax planning as a fall event. It's running a tax projection to make sure that you haven't missed any opportunities along the way during the calendar year. But that's not true at all. It really begins as soon as you've completed a tax return for the prior year. And as we present completed tax returns, because we do a lot of them for a lot of our clients, we're not just looking backwards and making sure that we're in compliance with a completed return for the prior year. It's all about turning the conversation then to the year that we're now into and looking ahead and saying, well, what can you do differently? And I tell you, there are many people out there who really want filing their taxes to just be a quick drop it off into the CPA's hands, let them handle it, and then tell me when I can pick it up.
Yeah, leave the car running in the parking lot. I'll
right.
just rush in, throw my stuff at you, and run out. And then you tell me when I can come in and sign.
Exactly. And if you're settling for that, if that was your experience this past tax filing season, you may be setting yourself up for either missed opportunities or maybe mistakes, some surprises in the future because you didn't pause long enough to begin that planning process right now.
So there's 6 areas to your financial life, the 6 areas of financial planning. We didn't come up with this, we practice it, okay? And this is the help, this is the financial help that you need. Instead of having a 401k investment person that has one objective for you and a CPA or you're doing TurboTaxes, you have an objective for you. A insurance person has an objective for you. An attorney has an objective. Instead of all of those potentially competing goals and plans, you need to synthesize all of those. That's right, I use that word. 6 areas: your present financial position, protection planning, tax planning. That's not tax preparation. Tax planning is a process. Tax prep is an event. Investment planning, retirement and college planning, and estate planning. Those are the 6 areas of your financial life. They need to be fused together. You need to look at all 6 of them and come up with one plan, one strategy, one goal instead of competing goals that aligns all of your financial decisions and actions.
Yeah, I mean, a great example of that is I met with a client and we were delivering his tax return, and his income was basically $1 million this past year. And he had taxable income. He had a chunk of taxable income. And we were going through his return and looking at every income component and saying, well, where did this come from and why? And there's some pretty amazing complexity to his return. But there was a chunk of income that he paid taxes on that he didn't need to. And I said, well, so what's the backstory here? And he's like, well, I have this investment guy in another state, and I've been working with him for a while, and he, I wasn't happy with this, and I wasn't happy with that, so we did this. And I'm like, and did you realize that you were going to pay tax on this chunk of income by doing so? And he said, no, that was my mistake. I should have been paying closer attention. And so it's very interesting to me to see how people react when there's a financial mistake that's made, because a lot of times when there's a mistake that's made, people just it seems like in the financial world they just own it. I'm like, what? It actually, I wouldn't beat myself up too bad for this. The person helping you should be saying, hey, if we do this, you're going to pay tax on this money. What's your tax situation looking like this year?
Right. The fact that it's taxable isn't a sole reason to say, oh, you shouldn't do it. But you just need to be aware. That's got to be part of the decision-making process.
Right? Well,
That's why you need those 6 areas to be reviewed as you're making financial decisions.
Sure, especially if it's in that year you're paying tax on twice as much income as you did in the previous year and you will in the subsequent year.
That's right. So here's the thing. When we look at tax planning, I often just oversimplify it and say it's doing 2 things. It's one, avoiding tax surprises. No one likes tax surprises. So you avoid tax surprises by being proactive and projecting and analyzing, okay, what do we think this year is going to look like? And therefore, what decisions does this inform? But then second is identifying and capturing the right opportunities. So let's break those down, isolate them. What are the potential surprises? Well, they result from changes going on in your financial life. Yeah. And your financial life changes all the time, and we often don't pause enough to say, well, how does this influence taxes? Yeah. So what are some of the changes that likely you could be going through, and how do they influence your taxes? What should you do about it?
A really big one that has been happening over the past couple of years, ever since the pandemic, a lot of people changing jobs. The Great Resignation, people leaving one employer, going to another. And every time that you leave one payroll structure and you enter into another one, it's an opportunity for you to make some adjustments to your tax withholdings, how much you're contributing to retirement plans, that sort of thing. And you may not make an identical decision in the new employer, right?
Oh, even if you think you made an identical decision. Yes, I filled out the W-4 the exact same way. I've heard that so many times that I just have to trust that you did. And yet, for whatever reason, your withholdings are wildly different than previous.
Yeah. And it's maybe compounded even more if you go from working for a local employer to one that's from another state, let's say. I have a client who they're in the process of relocating down to North Carolina, and he's already started working for that new employer, but hasn't officially moved, just doing some kind of commuting back and forth during the week. And they're not withholding any local taxes for the county here. They're withholding North Carolina taxes, even though he's still a resident of Indiana. And, thankfully, we had the conversation up front, and I was able to warn him, hey, this is going to be a problem on next year's tax return. We can solve it with some quarterly estimates, that kind of thing. But you don't catch that if you're not looking forward. If all you're ever doing is talking about taxes in the rearview mirror, then that's when surprises happen.
Can you imagine that rush hour traffic in the morning? You're getting up in Granger. Where are you headed? Got to get to North Carolina here by 8:15.
12 hours. Yeah. And I had the exact same thing, except my client took a new job in South Carolina, but I looked, they're withholding taxes in South Carolina. This person's living in Indiana.
Yeah.
So and this is where I would tell you, just don't go it alone. Like get some, seek wisdom.
But the other challenge with this, and we're going to hit this in just a minute, is the W-4, the tax withholding process has changed. It changed about 4 or 5 years ago. And we're running two systems at the exact same time. So you might think it's one way when it's actually another way. So there's a lot of other changes. We're going to help you avoid tax surprises, capture opportunities, that and more. Coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time every Saturday morning. Also on podcast at the same time, and also on a couple local radio stations at the same time, which is why the content is broken up and structured the way that it is. If you're looking for more content on financial wisdom and how to approach your financial life in a comprehensive way, make sure you hit that subscribe button, because we've got content that airs right here on this channel every weekday via 10-minute videos, 8-minute videos, something like that. So make sure you hit that subscribe button, turn on notifications so you're made aware every time we drop new content. And if you like the content, like the content. All right. We've got a lot more potential changes to hit, and then it's going to kind of weave its way back to updating W-4, having a pay stub projection done, looking at estimates, sort of thing. And then we'll get into opportunities. So,
sounds good.
All right, here we go. What life changes are going on right now that are actually going to create tax changes and potentially a tax surprise if you're not doing tax planning? We're helping you with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com. All over social media, we're there as well. Search the Wise Money Show. We're talking about tax planning, which is a proactive process. Tax preparation is a reactive process. Being proactive, you're trying to map out and look at, well, what's changed in my life or in my finances or in my taxes that could create a curveball if I, just don't do anything about it. So what are the potential changes? We're helping with that right now, and then capturing opportunities. So one potential change, and again, it feels innocent, and that is you switch jobs. Lots of people are doing that right now. The W-4 process is confusing. Kevin said last segment, don't go it alone. One of our all-star CPAs and CFPs, Jared Moxness, said the other day, he has filled out so many new W-4s with clients in meetings as he's delivered taxes, he can't even count.
Yeah.
So, and he's a numbers guy. So
okay, so in just in the spirit of being a jargon-free zone, the reason why you would fill your W-4 is for your withholdings. And the reason why you would do it, one big reason right now, because we didn't pay as much attention to this in past years, because if the government was holding on to your money and you got it back in April when you filed your taxes, it really wasn't a deal, because the government wasn't paying you anything to hold on to your money, but the bank wasn't either. And now you can get in the ballpark of 4% for that money. So if you say, well, if I've got 10 grand sitting there that's coming back to me in the form of a refund, that's $400.
Yeah.
That's real money.
Yeah, so you're talking about people who were withholding too much, and they may as well cut a thinner slice, get more in their paycheck so they don't leave so much money in the government's hands throughout the year. The opposite can happen as well, where things have changed within your tax picture. You're no longer withholding enough. And the easiest way to pay into taxes is a little bit every single pay period, right? So adjusting your W-4 is just a way to get your payroll department involved in you getting the right withholdings done each year.
And I know this is for another show, but it is fascinating to me when we sit down with people and deliver their tax return. And there's one client in particular, and he because he has a small business, he's always paying. So at the end of the year, he's paying the balance for last year and his first quarter estimate for this year. Mm-hmm. And whenever I show it to him, there's like this moment of silence, and he looks as if he can't go on. He can't muster the strength for another breath, another step, and then
Kevin, I told you that is confidential, but don't expose my emotions and reactions like that on the airwaves.
And so this is I know it's another show, but there is something incredibly emotional, and this is where you want to understand the internal finance, because if you say I have to get a refund, and it needs to be a big refund, then I would try to understand that just a little bit. Like, what is it internally that gives you that feeling? And I would find that, and I would stare it down, and then I would deal with it. If it still needs to be that way,
I think it's the cash flow surprise. I mean, the same thing happens when you have to replace. All of a sudden, you go in for an oil change. You find out you need to replace your tires. You get this. I get the same feeling. Well, how could this happen?
Yeah, that's right.
No, yeah,
It's been happening for 4 years, Mike.
I've driven this car for 70,000 miles. What do you mean I need new tires?
But it's like, oh my goodness, I wasn't prepared for owing, $800, $1,000, whatever. And so I think if the mindset shifts and you're proactive about your tax situation, so it's not a surprise, you've planned for it, and you're aware, you're going to owe $2,500 around there. You're going to owe somewhere between $2,000, $5,000, something like that. For these, if you have more complicated, then it's not an emotional deal, or it shouldn't be. Mm-hmm. But when it's this surprise, then it can be.
Mm-hmm.
Sure.
If we're talking about surprises that can, swing someone's tax picture from one year to the next, maybe they're not mentally or financially prepared for it. Another example, we talked about changing jobs. Some people leave an employer and then go start their own job. Start their own business, essentially, a side hustle or something like that. And if this is self-employed income, then, they may not be paying real close attention to just how much profit they've been generating throughout the year. So they don't have a real sense, like their gut's not telling them how much they're going to end up owing in federal income taxes. But then on top of that, you've got self-employment tax. And it's just another layer of tax that, in their mind, they never paid in the past. It was just all handled out of their paycheck when they were working for an employer or whatever. And so, just being aware that the side hustle income, yes, you can have some amazing write-offs, and there are some cool ways to take deductions and write off these business expenses and everything. But at the end of the day, the profit, it feels like expensive income to you because you are paying federal taxes, state taxes, and then this self-employment tax. And it can really surprise people that, oh, wow, I haven't been planning ahead for that, haven't been paying the right estimates in.
Kevin has mentioned this a couple times, said it's a topic for another show. I was hoping to get it near the end of today's show, but let's just hit it now. I call it this, the doom loop, the death spiral for small business owners or side hustle. And here's how that goes. Well, I started my small business, or maybe my small business or my side hustle started gaining some momentum this last year, wasn't being proactive with my tax situation. So I went in to file my taxes, but it's a small business and you're hustling. And so it's complicated. You delay filing. Let's say you still file in April. Well, when you get your tax return, you find out that, oh my goodness, I owe a lot of tax right now by April 15. And your CPA, your accountant, looks at you and says, well, how you doing this year? And he's like, well, yeah, I'm actually doing even better this year. So not only do you owe a lot of cash flow to pay for last year's taxes, now you owe your first quarter estimate by April. And here's what I often hear, guys. I'm assuming you hear this as well. Well, I don't have that cash right now, so I'll have to make it up later in the year. And then you sort of perpetuate this cycle of using this year's profits to pay last year's taxes, and you can't really get ahead. Mm-hmm. And then when there's this look of desperation, and as planners, we're trying to be creative. Well, here's some ways that you can lessen the tax. Well, it takes money to save money. Right. So you start looking and saying, well, for your small business, you should open a single K or a SEP IRA or a retirement plan, fund an IRA for your spouse, those sorts of things. Well, that saves you a lot of tax, and it keeps money in your pocket, just a different pocket in your overalls there. And but it saves you a lot of tax, but it saves you a proportionate amount of tax. So throwing $6,000 into an IRA, will save you a couple grand in taxes. Doesn't save you $6,000 in taxes, saves you a couple grand. So it makes sense to do, but it's all a cash flow pinch. So if you are thinking of starting a side hustle, you've just started one, you've just started a small business, or your small business is becoming a larger business, we just cannot express it enough. You need to be proactive about your tax situation. And the other thing, guys, and I know I'm on a soapbox here, you don't care. Because you care about your business. You care about the widgets you're making. Handling the finances, that's a totally separate part of your brain. Feels like a separate job. It's not even fun. So you want to ignore it. And you don't need to be an expert at it, but talk to a CFP who's going to do proactive tax planning with you.
And not just be proactive in the planning. It's be proactive in the planning so that you can be proactive in taking action with cash. You got to be conservative with cash. There are many businesses, and I'm thinking of one client in particular, he uses last year's profits to pay this year's taxes. The only way you do that is if you have a vision for the fact that, yes, as soon as I come into this year, I'm accruing a new tax bill, and I have to have the cash on hand to be able to handle this. Last year's profits are not just for all fun. It's not an amazing spring break. It's not a new car. It's that. No, this is first things first. I'm going to make sure that I've got my investments made and my taxes covered so that I don't get into a pinch. And you get behind the eight ball is exactly what you were describing. The issue is when you're struggling with cash, it changes the way you run your business.
Oh, yeah.
And you may be leaving some opportunities on the table because of it.
Yes, if you're listening to this right now and you extended and you have no idea what you owe for 2022 and 2023 is looking pretty good, but you don't feel like you have any control, get help. I think I finished the last segment with that.
Yeah.
Because I want to talk more about this doom loop because there are things that people try to do to get out of this doom loop that brings them even deeper.
Yeah. And we know not everyone has a side hustle, small business, so there's lots of other changes that you need to be aware of. We're going to help you with that and more coming up on the Wise Money Show with Korhorn Financial Group. Oh, yeah, good stuff.
Yeah, because the doom loop, because it can be solved, but how do people try and solve it? The retirement plan, like you said, might be, or what does the small business owner do?
Borrow?
No, buy equipment.
Yeah, expensive.
And it's like, okay,
I need a big write-off.
Yeah, I've got $50,000. All right, I know I'm going to owe taxes, so it's funny. I'm going to say $50,000 to buy a pickup truck. That buys you half a pickup truck right now.
That's crazy.
Yeah. So, it is. Yeah, very crazy.
All right, third segment. Let's get into it.
All right.
What tax planning opportunities are you exploring to reduce the amount of tax that you pay over your lifetime and have those change this year, resulting in you needing to make some changes right now? We're helping with that and more. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast, as well as a lot of all of our previous shows right there on podcast. So wherever you listen, search the Wise Money Show, subscribe to it there, rate the program as well. We appreciate it. Okay, we're talking about tax changes and how to avoid surprises. Kevin, we're in a niche right now. Individuals that have a small business, a side hustle, I would even say rental income. If you've got any of that going on, you need to be proactive with your tax situation. Before we go back to just the mass, the mass public and potential changes there, more about the doom loop, sort of death spiral here with small businesses. All of a sudden, oh, I didn't realize I owed all this tax, and I've got to be paying ahead for next year. I'm not able to do that. More about that.
Well, a lot of times, because you mentioned, hey, set up a retirement plan, set up an SEP IRA and pile a bunch of money into that, or a single K or what have you. And you say, well, if I owed $20,000 in taxes and I opened a retirement account and put $20,000 in there, I didn't solve the problem. I solved the percentage of the problem that my tax rate is. So if I'm in the 24% Fed and 5% state, I've solved about 30% of my problem. I haven't solved all of it. And a lot of times what we see with small business owners is they go to solve the problem by buying equipment.
I had too much profit. That's my problem.
Right.
I shouldn't have had so much income to pay taxes on.
And so that is a doom loop, because if I buy a bunch of equipment every year and take all of it via depreciation, and I'm not judicious, and my business is growing quickly, it's unsustainable. I can, and I remember the day that we sat down with Joshua and he showed us how we could grow our way out of business.
Yeah, right.
Like there are businesses that can grow their way to failure, and you would argue with that, because you say no. If you're growing, you're successful, and it could mean that. But it could also mean if you're not judicious in what you do with your money, you're going to have some big problems.
There's cash demands. This is where the phrase cash is king comes from. A lot of times people look at that and apply it to their personal life. It's really applied to business. Cash is what keeps you afloat. And yes, same thing with your personal life. But yeah. So, all right, let's shift and let's pivot back. And more changes, and I'm going to lump them into families, okay? One of the other big tax or life changes that influences your tax picture is you had a child. Okay, that typically helps on your taxes. By the way,
Doesn't help on the budget, though, right?
Yes, the kids always cost a lot more than the tax benefits. You had a child turning age 17. Talk about that in just a second. Child started college, child finished college. Mm-hmm. So those are more common than side hustles and businesses. They have a big tax impact and tax swings, Josh.
Well, it does, because it can change what kind of tax credits are available to you, for example. You know, getting a child tax credit one year and then not getting it the next year can be a significant swing on a tax return. If you were able to get an extra $2,000 off of your tax return because of a child who's under age 17, the year that they turn 17, now all of a sudden it's a different credit that's available. It's only $500. And what if you had, been used to getting a $1,500 refund every year, just like clockwork, and now all of a sudden you are break even? That can wreck some people's day, I was just used to always having this money, and now it's not there. Boy, I had already spent that in my mind, or that was going to cover this thing coming up or whatever. And so these years where a child turns 17, or a child was a full-time college student, and so they were a dependent, you were getting some college credits, which are extremely lucrative, many of them, up to $2,500 right off your tax bill for the first 4 years. And if in that fifth year, if they're squeezing 4 years into 5 or 6, all of a sudden that thing can be replaced with a less lucrative option.
And there's a lot of families have their kids in clusters. Josh, That's
right.
Did you space
3
the kids
years
out?
in a row? No, we did not.
So it's not a $2,500 tax credit. It could be a $5,000 or $7,500 tax credit that all of a sudden goes away, evaporates within just a couple of years. Shows up suddenly, you get used to it, and then disappears. So the big idea is being proactive. I think the big one, college, yes. A full-time college student all of a sudden shifting to part-time?
Yeah, drops below 12 credit hours, and now they're no longer a dependent. That's a big deal.
Yep.
Because, sometimes parents don't even realize that it might be happening. Yep. Partway through the semester, they drop a class because they're not doing well, or realize they're changing majors or something. And all of a sudden, it's a swing on your tax return because of it.
The big idea is, Kevin said, don't go it alone and be proactive. These kind of routine life changes can influence your taxes. And so then what do you do? Well, then it's taking a look at your withholdings, taking a look at what other adjustments. The one that I love is the parlay, where all of a sudden you've got these kiddos and you're getting a bigger refund. Well, should I change my withholdings? Well, yeah. And at the same time, we're going to increase your 401k contributions. So you take what would have been a big refund and you turn it into an even bigger tax benefit because you're using those dollars into a tax shelter. So, go ahead.
Well, I was just going to say, can I add one more before we kind of pivot into other topics? There's one more event that would fall under this same category of family changes. One could be marriage. Like you're getting married for the very first time, all of a sudden you're in a different tax bracket. That's a positive one for most people. But the opposite, the losing a spouse, someone passes away, or a divorce, and all of a sudden, for most people, when you've lost your spouse, the last thing on your mind is, what is this going to do to my tax picture? Right?
Yeah.
Like you're just trying to keep life together, pick up the pieces, try to reassemble some sort of normal. And you may not feel like anything is normal for a long, long time. But boy, I got to tell you, if you experience that kind of a tragedy, there's a limited window of time where your tax picture is going to change. You're going to go from filing a married tax return to a single one. And all of a sudden, you're in completely different tax brackets. Everything's different. But there may be some proactive planning that you can do at a time when the tears are still coming. You're still grieving. Like this is the last thing, and it feels so unimportant to even be talking about taxes. And so maybe you're listening right now, and you know someone who has experienced that kind of a loss. And I guarantee you, this is not on their radar anywhere. Mm-hmm. But it may be something that you can come along and just gently nudge in the right direction. If this is someone who doesn't have a financial advisor, doesn't have a CPA in their life, doesn't have a network of professionals who can rally around them and help them catch the details that they are not even aware of right now, then maybe one of the best gifts that you can give them is the encouragement to get started with some proactive planning. It's really in response to this major change in life.
Mm-hmm. If I've learned anything over my long, illustrious career, it's to not follow Joshua Gregory. So, but in the spirit of one-upsmanship, Joshua had one more thing, and I've got one more as well.
Yeah.
Think about a scenario. You worked for a company that might have been owned by the employees, and there was an event where that company got bought out, and you said this year, hey, I'm going to take my portion of that and roll it into an IRA. But I'd like to put a new swing set in the backyard or, fill in the blank. And so I'm going to pull some money out of that. So you do that and you don't really think about it. And maybe you pulled out a big chunk of money for that swing set. What did that do? What did that take away from you as far as things that you can deduct, various credits, other things? And so this is where I would encourage you, if you're going to be doing something like that, and you say, hey, I'm taking my long-term money and making it immediate and short-term. Mm-hmm. And as I have helped some folks in a situation like that, it's very difficult when you're 35 and have stretch marks on your cash flow to imagine that you're just going to be better off not touching that money.
Yeah. Yep.
So I would encourage you, if you're making short-term decisions with your long-term money, make sure you're fully aware of the tax consequences and you've prepared for it.
Yep, that's right. Talking about a ton of changes. Now, some changes happen with the opportunities that you're implementing to save taxes. We've got a long list of those coming up on the Wise Money Show with Korhorn Financial Group. All right.
Fourth segment.
Gosh. So this one, that's good. So we'll focus in on 401k contribution limits, IRA contribution limits, HSA contribution limits, 529 contribution limits, shifting from, I was going pre-tax, now I'm doing Roth, those sorts of things. And if we still have time, I'm assuming that'll take the whole segment, but there's still plenty more in the outline that we could go to planning around or talking through opportunities. So that's where we'll go.
No, even if we just spent this segment talking about contribution limits and understanding.
I think that's probably what we'll do. Okay.
Let's do it.
Here we go. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on the YouTube channel as well as a lot of other content. Make sure you go check that out. Go to YouTube, search the Wise Money Show. Subscribe to the channel, turn on notifications so you're made aware every time we drop a new show or all the content that we post throughout the week to help you make and take your next wise step in your financial life. We're talking about tax planning. Tax season's in the rearview mirror, right? But that's an event, and that's reactive. It really doesn't help you other than keep you out of trouble because you're filing and in compliance. It's tax planning that you actually save and avoid taxes legally. It's how can you pay the least amount of tax over your lifetime and really multiple lifetimes, multiple generations. That's tax planning. That's a proactive process, and it's a process, not an event. It's an ongoing piece of work. It's Josh mentioned, typically it's heavier in the fall. Yeah, that's right. But you've got to be aware of it in the spring when you're filing your taxes. You've got to pause for a moment and say, well, what changes are going on this year that I should account for right now? And that's because some of the tax planning opportunities that you're employing, that you're considering, they've got changes, and it's helpful to make changes in the spring so that you're not getting to November and saying, oh, wait, you mean I could have contributed an extra $7,000 to my 401k? Well, I don't have the cash to do that now, right?
Mm-hmm.
So let's talk through some of those opportunistic changes.
Well, you just hit one of them, and I think it's worth explicitly covering that the contributions to your retirement plan at work have expanded. They are significantly larger today than they were even just a couple years ago. And anyone who works for an employer that has a 401k, the most traditional of retirement plans, and there's others out there as well, you're allowed to contribute $22,500 now. Mm-hmm. If you're over age 50, you can do another $7,500.
Come on.
And so if you just had a golden birthday, a magic birthday, you may all of a sudden be able to go all the way up to $30,000 per year in contributions. Obviously, you have to have the cash flow to be able to do it. If you and your spouse are both working and both have a 401k available, you may both be able to max out these accounts. And so it is one of those situations where as you get closer and closer to this major retirement goal, a lot of people can play some great catch up there because the kids are out of the house. Maybe the mortgage is paid off. They're earning more than ever. And now they've got bigger buckets that they can dump money into for retirement and save some significant taxes because of it.
Yeah, I think there's four. The four that people typically look at are the IRA, the 401k, the HSA, and the 529. Because if you're asking the question, where do I put money in a tax sheltered, tax favored environment? That's typical. That covers probably 80% of the folks.
And those things are giving you a tax write-off in the year that you make the contribution.
Yes.
Because yes, there's a Roth version of many of these items, but that doesn't save you any taxes this year as you're making the contribution.
Yeah,
right?
at the same time though, let's not discount that, because while the Roth doesn't save you today, it saves you tomorrow. It saves you in the future. And so I still view that. That's sort of like saying, your financial aid package includes loans. Is that really aid? I don't know. So the Roth IRA contribution, I still that.
But
that
if
is,
we're talking about opportunities to impact this year's taxes, Roth's not going to get it done for you. For most people, if your income's low enough, you may be able to qualify for some savers credits and things like that.
I mean, we're kind of talking about opportunities to impact this year's taxes, but we're really talking about what should your cash flow be? I mean, really, because at a micro level, we're talking about that. But at a macro level, we're saying, what should your cash flow be? Yep. And where should your income go? And one of the questions that is a common question is people say, well, because I've done my retirement plan at work, I can't do an IRA. It's not true. It doesn't matter how much money you make, even we always used to use Bill Gates as an example. I don't know who makes a bunch of money these days, but even Bill Gates can fund an IRA. So he likely wouldn't be able to deduct it, and he likely wouldn't be able to do a front door Roth IRA, but he could do some tax planning type stuff. So I would just be aware, what are the buckets that I can save money into? And where will I get my money in retirement? Because Mike is, I think he's paid by the Roth IRA lobby.
I am.
Actually, the Roth 401k lobby. And so he's always.
He's got an NIL deal with.
I've changed my middle name, and don't ask about the tattoo on my back.
Yeah, they don't call him Mike Roth.
How low on your
401k for nothing. So
Best joke ever on a Wise Money show. Josh just got it.
oh dear. So I think you want to understand, because the things that impact your cash flow today, if you get the benefit today, there's a ramification in the future. If you don't get the benefit today, which is what the lobbyist is talking about today, you will get a benefit in the future. You will have an opportunity with those dollars that you wouldn't if you had different dollars.
Yeah.
And even if you don't live long enough to enjoy that, your beneficiaries will, right?
Yeah.
Receiving money from an inheritance in the form of a Roth IRA, it's may as well be worth 2 inheritances. Like that is golden.
Well, yeah, you sit down with a couple that's got $6 million in their IRA and 2 children, and you say, do you know that at the second death, these 2 kids are each going to have $3 million that they're going to have to pay tax on over a 10-year period?
Yeah.
So basically, you have your lifetime plus 10 to get the taxes paid on those. This is where the 30-year tax projection comes into play.
Yeah.
Because they actually move the goal post or the goal line, or they move the hockey stick. I don't know what they did, but it's now 75.
Yeah.
Yeah.
Okay, so the contribution limits Josh mentioned for the 401k, 403b, those it shifted from $20,500 to $22,500, and if you're turning 50 in this year, it's your limit's going from $20,500 to $30,000. That's a big deal. IRA contribution limits were $6,000. They're now $6,500. That catch-up contribution, if you're age 50 or older, or as I say, experienced in life, is still $1,000. HSA contribution limits, Kevin, you have those right there?
Yes, HSA, it's $3,850 for a single, $7,750 for a family, and that, if you hit the double nickel this year, or you're 55 or older, you can do an extra $1,000. So if you have a family plan, you could do an extra $1,000. Your spouse could do an extra $1,000.
And then the 529 plan, your contribution limit, nothing's really changed there. However, what has changed in our home state, Indiana, there is a significant tax credit, the best tax credit. You can't say that about it in Indiana that much. It's the best at anything. But the best.
Pretty good at growing corn.
Yeah, that's okay. You got me. Nebraska might give you a run for your money.
Well, we can play some basketball too.
So, but best, without question, best state 529 tax benefit, and that is a tax credit of 20%. Previously, it was on the first $5,000 that you contributed as a household. For 2023, they've increased that to the first $7,500. So the tax credit's still 20%, but the tax credit has increased by 50%, which that'll make you crazy, actually, when you say
Your tax credit's $1,500. You can get $1,500 back if you put $7,500 in. Is that the most I can put in? Nope. You can put way more than that in, but that's probably the most you want to put in if you're trying to get a credit. And you can use that money. They've changed all kinds of things with the 529, so that's another show.
That's right. So all of this, Kevin pointed this out, all of this deals with cash flow. And if you've sort of been with us the entire episode, and if you haven't, gosh, make sure you catch up. But tax surprises deal with cash flow. Tax opportunities deal with cash flow. We started by saying tax planning is one of the 6 areas of your financial life. And making sure that you're being mindful of your present financial position, your cash flow, your protection planning, HSA, should you have an HSA plan, your investment planning, well, if I'm funding all of these things into these tax shelters, do I even want to invest, or how should I structure that? Your retirement plan, how much should I be contributing? And then who's the beneficiary and what's the impact on my estate plan? Guys, you can't make these tax decisions in a vacuum. You need to look at all 6 areas of your financial life. All right. That's all the time we have for today. On behalf of Josh, Gregory, Kevin Korhorn, all of us at KFG. Have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.